Hello everyone, welcome to Tradeland FS Africa. I'm your presenter, Napeh Andrew. I'm a market analyst and FX educator with Tradeland FX. Today I'll be discussing with us market risk and volatility. Before we continue our risk statement. Okay, two entrepreneurs, Mr. A and Mr. B, want to open a filling station business. Okay, Mr. A now thought, risky business is this oil business. So is oil very volatile? What if someone lights a match? What do you think is going to happen to my business? Yes, your guess is as good as mine. It's going to go kaboom, right? There will be an explosion. However, Mr. B now thought, what if we put risk safety measures in place? What is going to happen? Of course, he's going to be in the money. Of course, but when you take care of risk, profit is inevitable. That is why we're going to be discussing about market risk and volatility, and of course, how you can profit from it. Okay, what is this market risk? Market risk is just the possibility that an entity or individual might experience losses due to factors that affect the overall performance of investments in the financial markets. What is market volatility? Volatility is how rapidly an investment tends to change in price over a period of time. So the rapid change in price is what we call volatility. Now, how do we measure this volatility? Should we use a table? Of course not. In the financial markets, we are going to be discussing about three among many indicators that we'll be using to measure this volatility. Yes, we're using the ATR, the Bollinger Bands, the moving average, MACD, some call it the MACD, which is the moving average convergence divergence indicator. Okay, what is the ATR? The ATR, also called the average true range. What does that mean? It means for a period, let's say for a daily candle, highs and lows for 14 days, if it is an ATR 14, then for the past 14 candles, 14 periods, or for daily charts time frame, it means the past 14 days, the average price movement. That's the average price movement. So you get it as the ATR. I will explain it to you in the next slide. Now look at this slide of a chart of British pound and the US dollar 1 day time frame. Okay, down here is the ATR indicator. Now let's look at the candles, which are in reds and greens. Okay, look at this area. There's a range here. As the market ranges, look at the indicator window. ATR has relatively low values. One thing we should know is that the ATR indicator doesn't tell you when to enter or get out. It's not an entry signal. It doesn't give you entry. It just shows you volatility, high or low. Okay? Now, as volatility intensifies, as you can see, to the downside and to the upside, the ATR indicator jumps to show you rise in volatility. Of course, you can see the candles, there's movement and change in price. So there's volatility in the market. That's how you make the money. Okay? So as conditions get calmer, the ATR records low values. It's something else I want us to see. Now, look at the edge of this ATR indicator, that tip there, and look at this ATR indicator value that's showing here. It's showing ATR 14, 0.0112. Okay, so this 0.0112 is telling you that for the past past 14 days, that's for the period now of 14 days, it means British pound US dollar pair has been making at least 112 pips. So if you understand what is happening in the market, you know how to take advantage of this value. That means every candle must move at least 112 pips. Okay, that's what it means. So you see how you can profit from this? Alright, come with me. Now go to the Bollinger Bands. Okay, the Bollinger Bands shows you as a visual. You don't see it at a glance what is happening in the market. You can see the Bollinger Band, you can see with the blue lines, we have the upper band, then we have the line in the middle, which is the 20 moving average, then the lower band is below. Now you can see that as price moves from A to B, you can see the Bollinger Band starts to expand. And you can see the rapid move in price. Candles are moving A to B. Now you can see B to C, there's rapid movement. Your Bollinger Band still expands, still expanded to D, still expanded. Then when it gets to E, something begins to happen. E to F, there is a constriction. There is a constriction, so there is contraction. Price is not moving, there is a range. Okay, but as it begins to open once more, you can see from F to G, there is volatility, and you can see price moves, and so on and so forth. Okay, let's look at the MACD. Don't forget the name, the moving average convergence divergence indicator. Okay, as the market ranges, you can see the MACD has little deviation. Can you see that? The histogram is not moving as much as it's supposed to move, and the signal line is almost flat. You can see there is no volatility showing on the chart and in the indicator window. And as we continue, see the volatility intensifies in the charts, and look at what is happening down in the indicator window of MACD. There's a rapid deviation. You can see the signal line is not flattened out, it's moving. The histogram are pointing down and pointing up. You can see. Okay, and so on and so forth. Alright. Higher volatility equals higher risk. That should not scare you, because when you see volatility and when you see risk, you see opportunity in the financial market. So don't be afraid to take risks. What is the importance of volatility? Volatility is important because of various strategies and psychologies. I'll say it again, because of various strategies and psychologies. For example, those who have low risk appetite, we want to go for low volatile currency pairs or assets. For example, the Euro USD, USD JPY, British US dollar, USD CHF, some currency pairs like that. For those who want to have gradual gains on their account balance. Okay, they want to improve and move gradually with low risk appetite. On the other hand, those who have high risk appetite, okay, will go for highly volatile currency pairs or assets. They may go for commodities like crude oil. They may go for currencies like CAD, JPY, British pound, Australian dollar, USD, Turkish lira. Yeah, currencies like that. Even gold, indices, S&P 500, the Nasdaq, the Dow Jones Industrial Average. We have them here. You can trade them, of course. Yeah, so they are all CFDs. They are CFDs, of course. CFDs, contract for difference. Alright, this is where we'll stop for now. We'll continue in the next video. May the pips be